The question on everyone's mind right now is, when should I start buying the dip? Well, using the word dip is pretty generous. We have companies down 40, 50, 60% from their highs, and a lot of investors, including me, want to know the best way to take advantage of the current market situation. Well, in today's video, we will break down an easy strategy that many professional investors use in these types of environments. We'll go step by step through everything, and by the end of this video, you will have a better understanding of the best ways to enter into this market and have the best chance of profit. So hit the like button to begin, and let's begin. Ladies and gentlemen, welcome back. My name is Pandrea, and man, oh man, what a market. You know what I've noticed? Everybody has a plan to make millions of dollars in the next market crash, but when they're actually in it, everyone just kind of freezes up. Nobody knows what to do. Everywhere you turn seems to be confusing you more and more, and everybody just ends up not doing anything and missing the boat and missing your $1 million opportunity. Then you say, okay, but next time I'll be ready. So how do we put a stop to all of that? Well, the first thing that we need to do is understand historically what the best thing to do in a market crash situation is. Sure, you can short the market, but that may be a little bit too risky for most investors. A more common practice would be to hedge your portfolio in the short term with some protection for the downside. So as the stock market takes a dip, you can minimize your losses along the way. So before we get into how exactly you can get into the market and make those potential millions, let's go over a few ways to hedge your positions until we get off of this bumpy ride. The first thing that you can do is buy protective puts. This is probably the most common way to hedge. You buy shares in a company and then you buy a put against it for protection. So if the company goes down, then your put contracts make money. Another alternative is to buy put contracts on the entire index as well that can protect your portfolio as a whole. The next thing would be to sell covered calls. This is another way to minimize your losses because when you sell a call above the current stock price, you collect a premium. As the stock moves down, that premium that you collected will act as a balancing act for your losses on your long stock position. Another trade that you can make in the short term is to buy call options in the VIX, the VXX. This tracks the Volatility Index. This is commonly known as the fear gauge and has an inverse correlation with the S&P 500. So when the S&P crashes down, the VIX shoots up. So when you think tensions are high and uncertainty is high, then you can hedge your positions by betting on volatility going up. Now, if you don't want to necessarily invest using options, which there are pros and cons to, you might want to look at an inverse ETF. Something like SPXS. This is the leverage inverse ETF of the S&P 500 index. So when the market goes down 2%, the inverse ETF will go up 6% because it's inversed and leveraged 3x. Now, the idea of all of these hedges is to make a bit of profit and use that profit to buy back into some of these companies that you would like to own at these new low prices. Which leads me to my next step. It's time to start choosing companies that you want to own for the long term. Buying good, solid companies and holding is the simplest and pretty much most effective way to grow wealth. Yet, so many people don't do it. And probably that's because it just sounds too simple, right? So what you're saying is I buy the stock and then what do? You just hold it. Okay, but then no, just hold it. Yeah, but what if I just hold it? So at these new low prices that we are seeing, it is time to start creating our portfolio. Now, you can go further into valuing these companies, looking at their income statements and things like that. But first things first, ask yourself, what companies will be here in 10 years time, 20 years time? Which companies are not going away? One example that comes to mind is Coca-Cola, right? I don't think anybody can really go wrong buying Coca-Cola for their long-term portfolio because I'm pretty sure that the company will be here in 100 years time. What about companies like Meta, Netflix, PayPal? All these companies have sort of collapsed in price recently, but have the fundamentals of these companies actually changed? Do you see them here in 10, 20 years? Do you see them growing in that time period? So once you answer these very simple questions, you can start making your list of companies that you want in your portfolio and that you would buy at low prices. This is very important because you need to be able to say to yourself that these current prices of the companies, that they're a good deal. Once you do that, you can move on to the next step. At this point, you might be thinking to yourself, all right, I made my list of stocks that I want to buy, and then I just buy these companies, right? Right? Not so fast. Let's ask ourselves, is there a better way to enter into these positions? Spoiler alert, there is. Now, to do this, you are going to need to have cash ready to buy at least 100 shares of the given company. For example, if I want to buy Dropbox, I would need $2,100 to buy 100 shares. Palantir, I would need $1,000. PayPal, around $10,000. So obviously being able to buy 100 shares of the company is going to depend on the share price. This is why it is very important to be able to consistently generate income from your job or from your business and save it properly in order to invest. Make as much money as you can on the income side and then put that money to good use rather than losing 2% to inflation. Sorry, hold on, what? What's that?
Inflation's not 2%.
Inflation's not 2%?
Yes, that's correct.
Oh, it's higher?
It is higher.
By how much?
About 8%.
Alrighty, so we have cash and now we are going to deploy it into the market. Now remember, you chose companies that you would want to own at these prices, right? So what we are now going to do is sell cash secured put to get into these companies at even lower prices. The benefit of doing this is to get the stock price at a cheaper price and at the same time collect that nice juicy premium. So an oversimplified explanation of this option trade is as follows. Hey, you. Me? Yeah, you. Would you like to buy this stock at a lower price than it is right now? Yes, sure, that'd be nice. Okay, great. Well, I will pay you cash right now if you agree to buy this stock if it hits that lower price that we agreed upon. Okay, thanks. And that's what happens when you sell puts. So it really is that simple. You will sell a put on a stock that you would like to own. Now, if you are already happy buying at these prices, these low prices, then logic would have it that you would be even happier to own them at even lower prices. So let's say the price of your favorite stock is sitting at $50 and you sell a put while having the appropriate cash needed to buy 100 shares of the company as collateral, right? You sell a put with a strike price of, let's say, $47, which is lower than the stock price, and you collect a premium for selling that contract. Say you collect a $2 premium, and because each option contract controls 100 shares, you'll be paid $200 straight into your account. Now, if the stock dips down further to $47 by the expiration date, then you will be assigned the shares of the company. Now, remember, you had $5,000 initially to buy 100 shares at $50. Well, now you have bought the stock even lower for $4,700, and on top of that, you have added $200 from the premium to your cash balance. This will bring your cost basis of the purchase even lower because you are factoring in the cash that you collected. This effectively means that you are paid to buy stock, the same stock that you were going to buy anyway at higher prices and without collecting any free money. Ha! Now, if you want to start investing, buying stocks, selling options, you might as well take advantage of opening up a Webull account and getting some free stocks. Webull is giving away 5 free stocks right now with the link down in the description. All you have to do is open an account to get 2 free stocks valued anywhere between $3 and $300. Then when you make a deposit of any amount, you will get 3 more stocks valued anywhere between $8 and $3,000. Also, Webull just opened up cryptocurrency trading on their platform, and they are giving away $5 in crypto for any trade you make above $1. Can't go wrong with that, so click the link down in the description and grab that free money. Okay, what comes next is the important part. You now own the stock, but what if it continues to go down? Well, remember, you were happy getting in on that stock at a certain price that was even higher, right? Now, whether or not you used options to enter your position, the fact still remains. Stocks go up and stocks go down, and you have to be able to think long-term if you truly believe in the company. I like to think of it as follows, and I catch myself doing this as well. The more that you have to look at an individual stock and its price fluctuation, the less you really believe in it. The less you check a particular stock and see what the price is, the less worried you are in short-term moves, right? So if you are confident that this dip is a buying opportunity for the future, then don't worry about what happens after the fact. Be happy that you got them at a discount, and hopefully years from now, you can go ahead and brag about how cheap you bought these stocks for. The second important thing to think about is what happens if you don't get assigned these shares. This could happen, of course, and that'll depend very much on how far away your strike price is that you sell to begin with. If you really want to get assigned and you are afraid of sort of missing the boat, then you want to sell puts close to at the money rather than too far out of the money. If you see that your strike price isn't getting hit, then you bring in your strike price closer to the stock price. You collect that premium. If it doesn't get hit again, bring it closer and closer. Now this is good because the closer your strike price is to at the money, the more premium you will collect. This actually is a very good strategy to get a sense when you are selling options and don't want to get assigned. If you're just selling just for collecting premium, then you know what strike prices to choose because now you've had experience getting assigned and not getting assigned. Typically, I would say sell puts with a delta of 0.3 on red days, on down days. And if you don't want to get assigned, then scale it up from there. Use it as a starting point if I am looking to move into the position before it recovers. Now, the third step is that after building your portfolio and seeing the power of selling options is to sell covered calls on your portfolio and make consistent monthly income. This entire process of selling puts and then selling calls is known as the wheel strategy. And I did an entire video on it, so if you want to take this to the next level, click here and watch the wheel strategy video. Check out my Patreon down below to follow my investments, and of course hit the like button if you learned something in this video. Thanks so much for watching, and we will see you on the next one.